Hello and welcome. Thank you for joining us on Business Incorporated. I'm Chimeze Obi Iwago. On the show today, Nigeria's headline inflation down by 0.02 points to 11.26% in October. South Africa's inflation meets forecasts as food prices fall in October. Plus, Tanzanian Exchange Bureau raided on suspicion of money laundering. We'll start here in Nigeria as the headline inflation drops by 0.02 points to 11.26% year-on-year in October from 11.28% recorded in September. According to data released today by the Statistics Office, the month-on-month reading shows headline index up 0.09 points to 0.74% last month from 0.83% the previous month. Average composite consumer price index for the 12 months period ended October 2018 was 12.78% from 13.16% recorded the previous month. Meantime, the food index went down to 13.28% due to increases in prices of fruits, meat, vegetables, and other products. The report noted that urban inflation advanced to 11.64% in October against 11.70% posted in September, while rural inflation was a notch higher to 10.93% from 10.92%. And in South Africa, the annual headline consumer inflation has increased to 5.1% in October from 4.9% in the previous month and in line with market expectations. Latest data from Statistics South Africa indicates that this is the highest inflation rate since July, mainly driven by transportation costs. On a month-on-month basis, inflation was flat at 0.5% in October after the same rate of expansion in September. Annual core inflation rate, which excludes cost of food, non-alcoholic beverages, petrol, and energy, remained unchanged at 4.2% and slightly below the market consensus of 4.3% in October. And let's see how the markets were doing at intraday. Starting with Africa, it looked like a red day today for the markets. Now, the local bourse here in Nigeria was trading lower at intraday, with the all-share index down 0.02 percentage points. Things were also looking southwards at the Johannesburg Stock Exchange. The benchmark index suffered a 0.06% loss at midday Nigerian time. Meanwhile, trade was also bearish in Egypt, with the equities coming in 1.26% down. On the flip side, the Nairobi Stock Exchange in Kenya gained 0.15% on Tuesday. Now, in the Middle East, mixed sentiment trailed the region. Stocks in Abu Dhabi and the Saudi Stock Exchange swam in negative territory, inching 0.40% and 0.02% lower at intraday. Equities at the Dubai financial market and Qatar was favored by investors, seeing the indices stronger at intraday by 0.24% apiece. In Asia, markets were mixed today amid shaky investor confidence after steep losses on Wall Street overnight. Greater China markets gained, with Hong Kong's Hang Seng Index rising 0.23% in afternoon trade. The Shanghai Composite rose 0.21% to close at around 2,651.51. The Shenzhen Composite added 0.54% to end its trading day at about 1,386 points. Elsewhere in Asia, stocks were mainly lower. Japan's Nikkei 225 fell 0.35% to close at 21,507.54, and the Topix Index shared 0.6% to end at 1,615.89. South Korea's Kospi fell 0.29% to close at 2,076.55. Stocks in Australia also saw losses. The ASX 200 fell 0.51% to close at 5,642.8, with the sectors mixed. And in U.S. stock index futures were higher as traders prepared for some respite from the latest wave of global selling. At around 4:20 a.m. Eastern Time, Dow futures were 133 points higher, indicating a positive open of more than 114 points. Futures on the S&P and Nasdaq were also relatively upbeat in the morning. U.S. stocks sold off for a second consecutive session on Tuesday as energy shares dropped with oil prices, while retailers including Target and Kohl's tumbled after weaker than expected earnings and forecasts. Nonetheless, a sharp drop in U.S. stocks has helped the safe haven U.S. dollar pull away from two-week lows. On the data front, investors are likely to closely monitor durable goods figures for October at around 8:30 a.m. Eastern Time, existing home sales data for October, and a final reading of consumer sentiment for November are both scheduled to be released at around 10 a.m. Eastern Time. Meanwhile, Dare, Cheetah Mobile, and Cardian are all expected to publish their latest quarterly earnings results before the opening bell. Let's see, back here in Nigeria, and following the recent flotation of $2.86 billion out of the Eurobond market by the federal government, Nigeria's debt sustainability has become a concern to the private sector. At a round table organized by the Lagos Chamber of Commerce and Industry recently, Chief Economist with PricewaterhouseCoopers, Dr. Andrew Nevin, expressed concerns on the misalignment between the debt level, population, and economic growth.
If we're not going to get poor, if we're going to lift people out of poverty, we need to grow about 6 to 8% per year. Now, I've heard, obviously they're friends of ours because PwC is friends with everyone, but you've heard the CBN stand up and say how fantastic their policies have been at averting a currency crisis, and we've come out of recession. We haven't come out of recession. If your population is growing at 2.7 to 2.8% and you're growing at 1.9%, you're still going backwards. So the mathematics of this are, we collect 6% of our GDP in taxes. There's been a big push by Mr. Fowler, the FIRS, to increase that. We haven't quite seen the result as a percentage of it. I'm not quite sure why, but I think the fundamental reason is it's very difficult to take more out of the tax system if the economy's not growing. And so people they have their income's stagnating, and then you're trying to take a higher percentage out at the same time. The only mathematics that works is the economy is growing. So the economy is growing at 6 to 8%. Your tax take can go up from 6%, 7% of the GDP, and then of course you've got a positive reinforcing loop on that, right? There's more resources to do all the things that we need in terms of government infrastructure product, more resources in terms of education and health. But where we are right now is in a very difficult place. So I think the good news is the debt level is still low enough, as we know, down at 19%, or it's 18.68, I think, on your chart, but we rounded the numbers, so 19%. So we're still low enough to fix our problems, but we're running out of time. As I said, how many more years do we continue to get poorer and poorer and poorer? And of course, we all know the fundamental things that we need to get richer. We need investment, as Bismarck says, so we need to be attractive for investment. So I think that we have a chance and we have time, but unless we get our growth rate up, we're going to be facing a very dire situation over the next few years.